Thanks for tuning into today's Talking Point. I'm your host, Neeraj Shah. Our guest today is Rakesh Arora, and he's no introduction. Rakesh, great having you. Thanks for joining in at the outset to wish you and the team a very happy 2023.
Thank you, Neeraj. Happy New Year to you and the BQ Prime team also.
Thanks a lot. Now, Rakesh, you reckon it could be a happy new year from an investing perspective, or are the challenges both from a micro and a macro level a bit too severe?
So, Neeraj, this year is starting like a year of contrast and contradictions. So, on one side, you have inflation and interest rate hikes by the developed market. On the other hand, you have, China opening up. So, there's a lot of optimism about, Chinese economy recovering and pulling the whole global market along with it. So, it's wait and watch situation. I would say there are balancing factors. Um, India has been one of the best performers, and if there's a flow into emerging markets, which is what it looks like to be this year, emerging markets are going to do better than developed markets. India should get its own share of inflows, which will come along with emerging markets. But since China has been beaten down so much, and it was given up, I think India could little bit underperform China this year. But I think overall we'll do much better than the rest of the world.
Why are you hopeful on flows, Rakesh? I mean, if anything, with US credit looking so buoyant for the first time in so many years, and US equities having beaten down, wouldn't the bulk of FIIs be finding more favor for DMs and US in particular as opposed to EMs?
Yeah, I mean, see that story is already played out. We saw huge outflows, from India, and now on the margin, I think things are going to turn slightly towards equities, and that is where I feel that emerging markets would attract their share of inflows,
Mm-hmm.
and it's never going to happen that only China would hog the whole thing, because India with its whatever percentage, 14-15%, is going to get that much share of inflows. So I'm hopeful that during this year FI inflows will be slightly positive as compared to what we have seen in last 2 years.
Okay, chalo. Jamata bhi, as they say. How are portfolios positioned in such a scenario then, Rakesh? I mean, because there are a few consensus bets across all smart money, and then, as would be the case, everybody's charting their own course on the remaining 25-30%. I would want to understand how you are positioning your portfolios.
So, Neeraj, I think the apart from the global factors, domestic factors will also come into play, and this is the last full budget which this government will be presenting. And given the historical trend, probably they will try to push more growth, and already there are signs of capex cycle revival. So I would think that would be the theme which will play out, infrastructure plus capex spending, and that is where I think one should be positioned. And while fiscal deficit is a worry and they have to scale it down, but I don't think this government is going to compromise on infra spending and growth in this crucial year before the elections. And so that is where I think my optimism is more towards companies and sectors which are geared toward this. And fortunately, some of those sectors have been less favored last 2 years, and valuations are not that stretched. So I would think that banking, where credit growth cycle is, seeing very robust, growth numbers, plus NPAs are low, and valuations are still below long-term averages. So I think banking will still remain one of the favorite into 2023. Then obviously there are infra companies which have done nothing in the last 2 years. Actually, they are scraping the bottom. So infra companies become important, I would say. The recent data is showing that NHI ordering has started to improve in November and December after a very weak first half. So infra companies definitely, and then cement is a theme which has been going on for some time now. I think it will also gather pace because it coincides with the busy season for cement sector, where cement price hikes would also be coming in. So I think these three sectors look really primed for good performance in 2023. Obviously, a lot of people are looking at metals also, given the China revival and India infra story. But stocks are not that cheap, and some part of it is already built in. But they'll also have a tactical rally. That is what I feel like.
Okay, so I was actually going to ask you because okay, let me start with the last point first, and then I'll move on to the others as well, including banking. But first on metals, Rakesh. Uh, the last time that we spoke, you were not very constructive, despite this impending China opening up as well. I heard you say right now that there could be a possibility of a tactical rally. Would you believe that the near term, the stacks are laid up for some upsides in the metal links, and why so?
So, see, it's not very clear. It's not like a post-COVID rally that we saw. But obviously things are bottomed out in terms of, say, steel margins or commodity prices for the near term. And this China reversal is actually a pretty sharp reversal. We never anticipated that they would do something like a 180-degree swing. So that has been one of the factors to change the view a little bit. Though still, I don't believe that the revenge buying in China, etc., would be commodity heavy, because most of the developers in China are either bankrupt or below investment grade. So initially, all the stimulus or the liquidity which Chinese government is throwing at them would go into beefing up the balance sheet. And commodity price and the property rates have to really climb up before investors would jump in back into that space. So I think it's a slightly long term, some time away before housing sector in China really picks up. That is one of the mainstay for commodity consumption. However, in the near term, there could be some restocking demand, and in any case, before the Chinese New Year, there's a little bit of restocking which happens, and all the stimulus, etc. So I think commodity prices are well supported in the near term because of the restocking cycle. And will the demand eventually come up is still a question mark to me. I think it will not be that intensive. So we would get a bounce, but it's not a start of another super cycle or a super rally where stocks go up 3x, 4x from the bottom. So I think there is a little bit of a move upside possible, but it won't really last for that long.
So it's not an investment call, but more of a short-term tactical trading call that you're making, so to say, for the next 1 or 2 months.
Yeah, I mean, see, we are not very clear what happens in second half of 2023. First half, China restocking, there's momentum. Second half, will US go into recession? Will it be mild recession? Will it be deep recession? Whether the China story will play out as we are expecting in the second half. So second half is not very clear. And in any case, if the developed world is going through recession, and even if China is going up, so 50% of the market is going down, 50% is going up, it won't really lead to a big upswing in commodity prices. So things are bottomed out. There's a little bit of restocking up move coming up, but it's still not a clear-cut, investment, call to buy the metal stocks.
Got it. You have been constructive on cement. So now for a while, we've seen that in the last 6 months, albeit from an investment slightly longer term perspective. I heard you mention that cement is one of the areas that you believe 2023 could have a good year. I don't know if it will be a banner year or not, but a good year for sure. We've seen some notes, Rakesh, of late, which are largely constructive, with one or two kind of doubting the pace of recovery, the pace of capex in a slowing world, and thereby the quantum of demand that might come in. How are you thinking about this whole picture? I mean, you've spoken about this, but it'd be lovely to just hear it at the start of the year.
So, Neeraj, I've always mentioned that volume is not the big driver in cement. So if somebody is really worried about demand growth, etc., I'm not that too worried. It's all about pricing. And prices have actually already moved up to compensate for high energy costs. They will move up again because we are getting into busy season. So at the same time, energy costs are receding. So oil is already down to less than $80. Petcoke is also dropped by 15-20%. So energy costs are coming off. Cement prices are stated to go up. So there is a margin expansion story which is playing out. And secondly, as we were discussing, that it's a pre-election year, 2023. Government is going to focus more on completing projects. Completing projects means more construction. So I'm hopeful that there will be even demand pull also, even though that's not the criteria that I'm looking for being bullish, but that's an additional tailwind which is there. So 2023 is quite set for cement, that energy prices will come off and cement prices are going up, and demand should be reasonably decent for everyone to be happy pushing volume. So stocks have risen a little bit since the last 6 months, but they are way away from their peak valuations. So there is scope for these stocks to go up further.
And coupled with that, the fact that the base effect of 2022 isn't the strongest on the fundamental numbers. So the comparative numbers might also look good.
Yeah, YOY numbers will look starkly much better as compared to last year. They were hardly making any profits.
Got it. Okay, so that's the view on cement as well. It's interesting how every cement company that you talk of is talking about organic or inorganic capacity expansion. It'll be really interesting to see how that shapes up. But we've spoken about that. Viewers, if you need some clarity on that, the previous conversation that we've done with Rakesh Arora actually speaks about that in great detail. So it's a wonderful one to log in. You mentioned banks, Rakesh. Seems to be a consensus call, and a lot of, I wouldn't want to make a derogatory remark, but a lot of non-fundamentally impressive banks too have inched up quite meaningfully in the last 6 months of the previous calendar. How do you pick your horses from here on, assuming that you were starting with a clean slate, Rakesh, and not existing investments? How would you pick and choose?
So, Neeraj, while the current credit growth cycle that we are seeing might result into an NPA 4-5 years down the line, so that's very some time away. But you rightly pointed out that the rising tide has lifted all the boats. So it is probably time to get out of some of those banks which have historically not done that great if they're trading near book value. And some of the high quality private sector banks have actually not performed that much, and time to get onto those banks, I would say, because they would do much better in terms of the quality of lending and how they come out of this whole up cycle. So maybe time to book some profit on those small time PSU banks and move to large private banks. I think that is the call, because valuation differential is not that great now anymore for those PSU banks.
Got it. Even the mid-sized or the small-sized private banks as well, not those, and you would rather stick to the large ones.
Yeah, meaning if the private bank, mid-sized private bank is trading at 1.2 time price to book, why should I look at a PSU bank even at 0.8? So, so better to shift to better quality, and because this upcycle in lending, etc., will eventually come back in NPS someday. So I think we have seen that market tends to be very smart. They will exit well before it happens.
That's true. By the way, Rakesh, just since we are on the topic of financials, one quick question on what's happening at the NBFC end. Simply because, I mean, after a really strong quarter to Bajaj Finance, yesterday was the talking point of town by virtue of what that did, and even it was just lower than expectations, I thought, and not really a dismal quarter, so to say. But if BAF goes through that, then a lot of others might also go through some pain or the other. What's your view on NBFCs at large?
So NBFCs, meaning obviously there are two buckets to that. One is the digital lending bucket, where the entry of Geo has ruffled a little bit of feathers, and so that was the theme which was already floating into the market, that it might impact Bajaj Finance in a big way. And so a small disappointment has actually led to an disproportionate impact. I think it's an overreaction in the near term. Longer term, difficult to say. Technology is changing so fast, and but this kind of lending is very difficult, and NPAs can mount very fast. Meaning lending is easy, getting the money back is difficult. So that bucket was actually getting a premium valuation. And so the room for error is very low, as we have witnessed in Bajaj Finance. But then there's the other bucket, which is, on the ground doing secured lending, which I think will continue to do well because they are going through a big, credit cycle themselves. So I think secured lending, whether it is gold loans or whether it is housing loans, or I think that bucket seems much more secure and uh, uh, lucrative at the moment as compared to the digital lending.
Okay. My final question, Rakesh, is on capex ancillaries and maybe building materials fit out there, because not only were they benefiting thus far from a slight uptick in this real estate cycle that we've seen, but if indeed capex comes up, then a lot of these real estate ancillaries might also be capex ancillaries, so to say. So it's the best of both worlds, which a lot of bulls are betting on. How do you think about it?
Yeah, I mean, cap goods is a theme which has already been playing out last 1 year. And I think that theme will continue to play out as, orders. So there again, there are some initial, in the capex cycle, some companies benefit in the initial phase, others benefit in the second phase. So I think this rally in cap goods, etc., is far from over. It's actually just starting. So I would think that space would continue to benefit. There are, a lot of small cap companies in those spaces where they're into niche segments. So it's a bottom-up market for cap goods. I think people have to figure out, which companies are doing well. But I think overall, top-down view, cap goods as a space is going to do, the same thing that they've done in 2022.
Ancillaries thereof, Rakesh, you reckon that could be a good way? A few people are again talking about how they would use the ancillary route to play, as opposed to buying a real estate company or buying a cap good company or buying a large capex company which is doing a large capex. Instead, let's buy the beneficiaries or the ancillaries.
I think the big move will still come in real estate companies because their land banks have suddenly become highly valuable, given that land prices have been jumping up. And the other thing which I feel is that and now there's a visibility on monetization of that land bank. So I think for real estate, buying the real estate play itself and companies with large land banks would be the way to go, rather than just the developers. So I would think that some of our client companies, I'm seeing the massive value unlock happening from their fully paid land bank, and most of these companies are now debt free or closer to being debt free. So there's a big value unlock happening. So I would stick with pure real estate companies with big land banks.
Well, that's a contra view. Stick with pure real estate companies and go for land banks as opposed to developers. It's a contra view. It'll be lovely to see how it shapes up, Rakesh. I'm not doubting you. I'm just saying that's a very word.
Fully paid land bank.
Sure.
And companies are debt free. So I'm not saying guys who are buying now.
No.
Guys who are stuck with legacy land banks.
Yeah,
they have struggled their way through, shoring up their balance sheet, and now they are just out of it. It will be foolhardy to sell them now when they've done the hard work and they are in the phase of monetizing that land bank. So I think there are a lot of plays on those, that space where there could be a multifold returns possible.
Very interesting. Rakesh Arora, always a pleasure talking to you. Thank you so much for doing that yet again today, and wishing you a great 2023.
Thank you. Same to you. Thank you.
Cheers. Viewers, thanks for tuning in.